Since time immemorial, all of us have been taught the benefits of saving. But is saving enough? Are you saving or investing? Let's get to know the investment products in the market to grow our money. Welcome to the video on investment products. An investment product is basically an asset or an item that is purchased by the investor in hope of generating profits. The profits can be in form of income earned on the asset like dividends, interest or equity profits, or in form of appreciation of the value of the asset. In economic sense, investment products or investment instruments are those assets or items that an individual buys not for present consumption but for use in future to create wealth. Let's look at the common terms in the investment industry. Let's discuss maturity. Maturity is the time interval after which the investor gets income out of purchased investment product. It is an important criterion for judgment of the investment product. It is well known that time is equal to money, therefore, the same amount invested in different investment products with different maturities would give different incomes. Generally, longer the maturity, higher is the income from a specified investment product. Therefore, one should try to invest in instruments which have a high return and have a lower maturity period. The next term is interest. Interest or ROI is the most important criteria for an investor based upon which most investment decisions are taken. The purpose behind any investment is to earn profits in future. Interest is the measure of profits in terms of percentage of actual investment per unit of time. It is also called the return on investment or simply ROI. One should make sure that the percentage of interest received is greater than the country's inflation rate. The next important term to be considered is risk. Every investment is subject to risk. Risk is the chance that investment's actual returns vary from what was expected. Risk includes the loss of investment or a part of it. Risk also has an association with returns when we talk of investments. Let's now explore the term liquidity. Liquidity simply means the ease with which the investment product can be converted to cash or cash equivalent. It involves the cost required for the conversion and the time involved. A highly liquid investment would convert into cash or cash equivalent with minimal expense and within minimum time. Sometimes liquidity can mean that your instrument is freely tradable in the market. Securities with good credit ratings are more easily traded and hence are considered to be more liquid. The next term that is to be explored is currency. Every investment product can be bought using a specific currency. This defines the acceptability of the investment product in different markets. It also decides how sensitive the product is to currency fluctuations. Today, with increasing cross-border trade and investments, currency risks in an investment are becoming more relevant than ever. Let's describe face value. Face value is the amount of money a particular investment product is worth. It is the amount in principal that will be redeemed when the investment matures. The next term to consider is the issuer. It is the individual, company, or the government who creates or issues an investment product. Let's take a look at what a guarantee is. Guarantee is the legal agreement that the buyer of the investment product gets so that he can be compensated if he suffers any loss due to the purchase of that particular investment product. Yet another important term in the investment arena is returns. Returns basically mean what one gains in return from an investment. The return could be of various forms. It can be calculated in two ways. Returns on an investment can be calculated through capital gain. Capital gain refers to the change in the value of the investment product over the period it was held by the investor. It is often seen that the market value of an invested asset appreciates over time. This change in price is considered a gain and is included in the calculation of the return on investment. For instance, Mr. Jones bought a land in January 1990 at $2,000. Today the same piece of land can be sold in the market at $5,000. The capital gain from the land is $3,000 and the return on investment is $3,000 by $2,000, which makes 150% over the time period the land was held with Mr. Jones. Another aspect of gain from an investment product is the periodic cash inflows caused by the investment product. For example, if you buy a bond or invest in a deposit, the investment will pay you interest periodically. These cash flows also determine your returns. For example, A bond worth $20 promises to pay the bearer a sum of $5 every year till the time of its maturity. We will include that $5 as the gain from the bond, and the return on investment will be calculated as 5 by $20, which is 25% per annum. An investment product can have either capital gain or periodic gain, or both. A stock can have gains in both forms simultaneously. Its price in the market can appreciate, and at the same time it can generate income in the form of dividends to the owner.